Hello and welcome back to the channel and to a short video about a US company called Trane Technologies. Now, as you could see from the thumbnail, this is a very solid and good stock, but does that mean necessarily that it's a good buy? Well, let's have a look at it. Trane Technologies is a cooling and heating company. They are doing climate control and all sorts of stuff, and you can read more about them under Trane Technologies here. They have some sub brands, but as you know, we normally mainly look at the numbers. In question number one, is it a solid company? Does they make money? Number two, are they a well-valued company? Are they priced correctly? And number three, is this the time to buy? So if we're looking at the quality, we can see it's a fairly big company. It has a market cap above $71 billion. The quality is good. Momentum is high. Overall stock score is 82. The PEG ratio is 2.4, so we are not paying an insane amount for future growth here. And we can see they have a PE around 30 to 36 here. Going down here, we can see F score is 7. Z score is telling us it's very safe, and the analysts overall like the company. So going down here, return on capital employed is very good, above 20. We just want it to be above 12, so above 20 is great. They can easily cover the dividend both with their free cash flow and their overall earnings. The free cash flow is growing, that is great. a decent quick ratio, good interest coverage. Overall, this is a good solid company. And just looking at this could make many investors think, I gotta own this company. This one has a place in my portfolio. Looking at the price development, you can see here from the spring of 18, meaning 6 years ago, it has gone up 400%. So a 5x in price. Now, a good little exercise here is to then look at earnings per share growth. We can look at it in a chart. We can look at it here. It is moved one place to the right here. So this is the number from 18. And you can see here they did a 6% earnings per share growth, 8%, minus 40, plus 67, 27, and 17. So overall, you can see this is nothing near a 5x on the earnings. So we can see that the price on the stock has gone up a lot more than the earnings has. That is the first little warning signal to us. But our question number one, is it a good solid company? Yes, it is. Let's have a look at the valuations. Now, looking 2 years into the future here, the analyst thinks this has a target that is 2.5% below the current price. Now, this is not too comforting, I would say. But let's have a look at it ourselves. They are expecting a growth of 17.5% and almost 12% over 24 and 25 here, with a price earning of roughly 27. How has the price earning been doing before? Right now it is at 36. Then it was at 27, 22, has been up in 41, but looking back over time, it has rarely hit 20. Now, 22 and 23, it did hit 22 and 28 here. So maybe 26, 27 here is a reasonable place to be. At least 36 right now is only beaten by the 2020 here. So that would mean that investors should be willing to pay one of the highest price earning ratios in the entire history of the company, or at least the history we have available here. We can see that the last 3 years has had an average of 28, last 5 years 28.8, last 10 years 21. So I would say a 26, 27 is a fair level. Now, how much should it actually be before, with this growth rate, if the 2-year return was reasonable? We can try and see if we want more than just an interest, a risk-free interest. So I would say something like a 20-25% over 2 years is a minimum. which means that 34 should be a place where the price earnings should be, at least with these growth numbers here. So as of right now, I actually would think that 27 is a reasonable place. They came out with some good guidance and stuff, so this might even go up a bit. Let's try and bump up the earnings a bit. 20 and let's say 15 here. That is a lot more than analysts think that it will right now. And then at a P of 27, it only gives you 1.6% per year. And even at a 30 or 33, well, 12.3%. That is a decent return, but it's not mind-blowing. So this actually tells me that right now I would consider Trane Technologies too expensive. You might disagree and you might have some insight saying, yeah, well, they're going to blow up completely and they are going to go up by 50% here. And that is fair enough, that if you know something, that is okay. However, this is not what the average analyst thinks. And this is a fairly big company, so there are a lot of analysts covering this. So that tells me that the numbers here are not completely far off. As I said, it could be a bit higher, but that wouldn't change that much. Can even try and bump them up a bit more. At this price earning, it doesn't look too well. This is not my favorite type of company, and it would fail my second question, is it priced correctly? I would wait for some sort of retracement of 10 or 20%, and then it might be just the right time to buy. We can look at the TPI chart, where we can see that it is in a long-term good green uptrend here. We can actually see it has been oversold, accumulating here and going into green. So that is a good sign. And a little retracement here, if you're a swing trader, a little retracement down towards the 300 and then a good green bar might be a buying signal. But for my long-term portfolio, Trane Technology is a no-go as of right now. That doesn't mean it can't go up 100%. It just means it doesn't fulfill my own personal criteria for buying a stock. That's all for now. Hope this was inspirational. Take care of yourself and your money out there. Bye for now.